Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and entertainment purposes only. The information provided is based on my own research and experience, but you should always consult with a qualified professional to discuss your specific financial situation and insurance needs. Your decisions are your own. The moment you pass your driving test, a giant, invisible target is painted on your back. You can't see it, but every car insurance company in America can. To them, you aren't just a new driver. You are the single most profitable and riskiest customer they will encounter all year. And they have a multi-billion-dollar system designed to do one thing: charge you the absolute maximum price they can legally get away with. They are banking on your excitement, your inexperience, and your confusion to get you to sign on a dotted line that could cost you thousands of dollars more than it should. I remember the feeling. Holding that freshly laminated license in my hand felt like holding a key to the entire world. The freedom was electric. I'd already picked out a car. A 10-year-old Honda, nothing fancy, but it was going to be my car. I spent a week imagining the road trips, the late-night drives, the simple convenience of not having to ask for a ride. The dream was real. And then I made the call. I started getting insurance quotes, and the dream died. The numbers I was hearing were astronomical. $200 a month. $300. One quote came in at over $400 a month. That was more than the car payment. Suddenly, the key to freedom felt like a key to a financial prison. The open road looked like a toll road, and the price was just too high. I was angry, I was frustrated, and I felt completely powerless. It seemed like my only choice was to give up the dream or go completely broke. But what I discovered after weeks of obsessive research, phone calls, and deep dives into the fine print is that there is a third option. That option is to understand the game better than they do. Because that's what this is. A game of statistics and risk. And if you don't know the rules, you are guaranteed to lose. So, why are you considered such a massive risk? It's not personal. They don't know you. They don't know that you're a careful driver, that you never text and drive, that you're more responsible than all your friends. They don't care. All they see is a ghost. You are haunted by the statistical ghosts of every 16, 17, and 18-year-old driver who came before you. The ones who sped, the ones who made dumb mistakes, the ones who got into accidents. In the cold, hard math of the insurance world, you are not an individual. You are a number in a data set labeled high risk. An insurance company is basically a casino. They are placing a bet on you. They bet your monthly payment, your premium, that you won't get into an accident. You are betting your premium that you might, and that they'll have to pay out a massive claim for a new car or, even worse, medical bills. And just like a casino, the house always sets the odds in its favor. For new drivers, they don't just tilt the odds. They bolt the table to the floor at a 45-degree angle. Your lack of a driving history is, to them, the worst driving history imaginable. It's a blank slate, and they are going to assume the absolute worst. But this is where we fight back. This is where you take back control. Over this series, we are going to dismantle this entire process piece by piece. We are not just going to find you cheaper insurance. We are going to find you the best insurance for your specific situation. We will crack the code on what liability, collision, and comprehensive actually mean in plain English. We will uncover every single discount you are entitled to. From good student discounts to defensive driving courses that can slash your premium by 20%. We are going to turn you into the single most informed, confident, and prepared new driver an insurance agent has ever spoken to. We're going to turn their game against them. And it starts right now with the single most important decision you will make in your first year of driving. This one choice can be the difference between a $100 a month premium and a $400 a month nightmare. The question is, should you be added to your parents' policy, or should you get your own? The default answer for most families is to just add the new driver to the existing family plan. And in 90% of cases, this is absolutely the right move. Let's break down why. When you join an existing policy, you are essentially borrowing their driving history. Your parents, who have likely been driving for 20 or 30 years with few or no accidents, represent a low risk. The insurance company averages you the super high risk, with them the super low risk. This brings the overall risk profile down, and with it, the price. Furthermore, you get to benefit from all the discounts they've accumulated. The multi-car discount, the home and auto bundle, the loyalty discount for being with the company for 10 years. You get a piece of all of it. This is, without a doubt, the easiest path to an affordable premium right out of the gate. The increase to your parents' bill will almost always be significantly less than the cost of you getting a standalone policy. We're talking a potential difference of hundreds of dollars every single month. However, and this is a huge however, it is not always the right move and you need to understand the risks. The first risk is financial. If you get into an accident, it's not just your car or your record on the line. The claim goes against your parents' policy. This means their premium is going to skyrocket, potentially for years to come. It can also cause them to lose any claims-free discounts they have. You have to have a very honest conversation with your family about who pays for what. Who covers the deductible? Who covers the increase in the premium if an accident happens? Putting this in writing isn't a bad idea, because money can make family relationships very complicated very fast. The second and more serious risk is liability. If you cause a serious accident where the damages exceed the policy's coverage limits, the lawyers for the person you hit won't just come after you. They can and will go after the policy owners, your parents. Their assets, their savings, their home could all be on the line. This is why, if you go on their policy, it is absolutely critical to make sure they have high liability limits and, ideally, a separate umbrella policy for extra protection. Don't just assume they have enough coverage. Ask to see the policy declarations page. So, when does it make sense to get your own policy? It's rare, but there are a few scenarios. If your parents have a terrible driving record with multiple accidents and DUIs, their risk profile might be so bad that adding you actually doesn't help much. In that case, starting fresh on your own might be comparable in price and protects you from their record. Another reason is if you own a high-performance or expensive car that their insurance company won't cover for a new driver under their policy. Or, most commonly, it's a matter of independence and responsibility. You may simply not live at home, or you want a clean break and to build your own insurance history from day one. Building your own insurance history is like building your credit score. The longer you have a clean record on your own policy, the better rates you'll get in the future. Starting at 16 or 17 means that by the time you're 22, you'll have a 6-year history of safe driving, and your rates will be dramatically lower than for someone your age who is just getting their first policy. So, your first mission is clear: have that serious adult conversation with your family, get a quote to be added to their policy, and then get several quotes for a standalone policy for yourself. Compare the numbers, discuss the risks, and make an informed decision together. But what if you don't have that option? What if you're 18 living on your own and have to start from scratch? That's when you are at your most vulnerable. That's when you have to understand the core components of a policy yourself. And it all begins with the single most important and most misunderstood type of coverage there is. Getting this one thing wrong can not only cost you thousands in premiums, but it can financially ruin you for the rest of your life if you get into a serious accident. And most new drivers are dangerously underinsured here, and they don't even know it. The reason so many new drivers are underinsured is because they make one simple catastrophic mistake. They just buy the legal minimum. They go online, check a box that says, state minimum coverage, and assume they're protected. They assume that if the state says it's enough, it must be enough. This is one of the most dangerous financial myths you can fall for. Let's be brutally honest. State minimum insurance isn't designed to protect you. It's designed to protect everyone else from you, and only up to a laughably small amount. It's the government's way of ensuring that if you cause a minor accident, there's at least some money available to fix the other person's car. But what happens in a real-world serious accident? Let's run through a scenario. You have the state minimum liability coverage, which in many places is something like 25/50/25. We'll break down what those numbers mean in a second. You're driving on a rainy night, you don't see the car in front of you brake, and you rear-end them. It's not a huge crash, but it's a solid hit. The other car is a brand new Toyota Highlander. Just the initial estimate to repair the bumper, tailgate, and sensors is $26,000. Your state minimum property damage coverage is only $25,000. Right off the bat, you personally owe $1,000. That's just for the car. But the driver and passenger in that Highlander are complaining of neck and back pain. They go to the hospital, get MRIs, and need months of physical therapy. Their combined medical bills hit $75,000. Your state minimum bodily injury coverage is $50,000 total for the entire accident. That means after the insurance pays its limit, you are now personally on the hook for another $25,000 in medical bills. So in this one very common, not even worst-case scenario accident, you are now $26,000 in debt. Your insurance company writes its checks and wishes you the best of luck. The other driver's insurance company and their lawyers will then come after you. They will sue you. They will garnish your wages. They will put a lien on any property you own. All that money you were saving for a down payment on a house? Gone. Your future paychecks? A portion of them belongs to someone else for years to come. All because you opted for the state minimum. This is why we have to talk about the fundamental building blocks of your insurance policy. Think of it like building a fortress to protect your financial life. The first and most important wall of that fortress is liability coverage. Liability is the part of your insurance that pays for damage and injuries you cause to other people and their property. It does absolutely nothing for you or your car. This is the coverage that is legally required in almost every state. It's broken down into two parts, represented by those three numbers we saw earlier, like 25/50/25. The first two numbers are for bodily injury liability. The first number, the 25 in our example, is the maximum amount in thousands of dollars that your insurance will pay for a single person's injuries in an accident you cause. So $25,000 per person. The second number, the 50, is the maximum amount your insurance will pay for all injuries combined in a single accident. So $50,000 total. If you hit a car with 3 people in it and they each have $20,000 in medical bills, that's $60,000 total. Your policy only covers $50,000. You're on the hook for the extra $10,000. See how quickly this adds up. The third number, the final 25, is for property damage liability. This is the maximum amount in thousands your insurance will pay to repair or replace any property you damage. This is usually the other person's car, but it could also be a mailbox, a fence, a storefront, you name it. And think about the cars on the road today. A new Ford F-150 can easily cost $60,000. A Tesla Model Y, $50,000. A lot of common SUVs are in the $40,000 range. That state minimum of $20,000 or $25,000 in property damage coverage is a joke. It might not even be enough to cover a brand new Honda Civic. If you total someone's new truck, your insurance will pay its $25,000 limit, and you'll get a bill for the other $35,000. So liability coverage is your first, non-negotiable line of defense. It protects your assets and your future income from being taken away in a lawsuit. Getting this part wrong is financial suicide. But liability only covers the other guy. What about your car? If you have only liability insurance and you cause an accident, you get a check for $0 to fix your own vehicle. You could have just bought a $20,000 used car, and the moment you crash it, it's a total loss and you have to eat the entire cost. That's where the next two types of coverage come in: collision and comprehensive. Let's start with collision. This one is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. That usually means another car, but it also covers you if you hit a stationary object, like a telephone pole, a guardrail, or a parking garage pillar. It's the "I messed up and hit something" insurance. Pays out regardless of who is at fault. If someone else hits you, their liability insurance should pay for your car. But if they're uninsured or it's a complicated fault situation, your own collision coverage can step in and pay for your repairs, and then your insurance company will go after the other driver's company to get their money back. Now, when you buy collision coverage, you have to choose a deductible. A deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. Common deductibles are $500 or $1,000. Let's say you have a $1,000 deductible, and you cause an accident with $8,000 in damage to your car. You pay the first $1,000 to the body shop, and your insurance company pays the remaining $7,000. The higher your deductible, the lower your monthly premium will be. But you have to be honest with yourself. Can you comfortably write a check for that deductible amount tomorrow if you need to? If a $1,000 surprise bill would wreck your budget, you might want to consider a lower deductible, even if it means a slightly higher premium. The third piece of the puzzle is comprehensive coverage. Sometimes this is called other than collision coverage. This is your protection against all the weird, random non-collision stuff that can happen to your car. Think of it as the act of God or bad luck insurance. Comprehensive covers things like theft, vandalism, fire, hail damage, flooding, a tree branch falling on your roof, or hitting an animal like a deer. These are all things that are completely outside of your control. You could be the safest driver in the world, but you can't stop a hailstorm from denting every panel on your car. You can't stop a thief from breaking your window and stealing your stereo. Just like collision, comprehensive coverage has a deductible that you have to choose. And again, the same logic applies. A higher deductible means a lower premium. Many people choose to have the same deductible for both collision and comprehensive to keep things simple. Now you'll often hear the term full coverage. That's not actually an official insurance term. When people say full coverage, what they really mean is a policy that includes all three of these core components: liability, collision, and comprehensive. If you have a loan on your car or if you're leasing it, you won't have a choice in the matter. The bank or leasing company that technically owns the car will require you to have collision and comprehensive coverage. They have a financial stake in that vehicle, and they need to make sure their investment is protected if you wreck it or it gets stolen. They'll usually specify the maximum deductible you're allowed to have too. So to recap, liability protects everyone else from you. Collision protects your car when you hit something. And comprehensive protects your car from just about everything else. These are the three pillars of a solid car insurance policy. Understanding them isn't just about passing a test. It's about building a financial shield. Because when you get behind the wheel, you're not just driving a car. You're piloting a 2-ton metal box that has the potential to create hundreds of thousands of dollars in damage in a split second. So we've unpacked the what, liability, collision, and comprehensive. But the real question, the one that separates a smart policy from a useless one, is how much? How do you pick the right numbers for your liability coverage? Because choosing 25/50/25 versus 100/300/100 isn't just a small tweak. It's the difference between a minor inconvenience and total financial devastation. And in the next part, we're going to break down exactly how to choose those numbers to bulletproof your future without overpaying. So let's talk about those numbers. Because understanding this is the single most important financial decision you'll make as a new driver. Forget stocks, forget crypto. This is ground zero for protecting your entire financial life. Imagine this. You've just gotten your license. You're driving your first car. Maybe it's an old hand-me-down, maybe it's something you saved up for. You're being careful, but you're still new to this. You're at a red light. You glance down at your phone for just 1 second to check a notification. The light turns green. The car in front of you starts to go, then suddenly stops. But you're already looking up and hitting the gas. The sound is sickening. A crunch of metal and plastic. Your airbag deploys in a dusty, chemical-smelling cloud. You've just rear-ended a brand-new Lexus SUV. But it doesn't stop there. The impact shoves the Lexus into the intersection, where it clips a Honda Civic, sending it spinning into a minivan in the next lane. It's over in 5 seconds. A simple, common mistake. A moment of distraction. But the consequences have just begun. The driver of the Lexus is complaining of severe neck and back pain. The person in the Honda has a broken wrist. In the minivan, a child's car seat was jarred so hard the toddler inside needs to be taken to the hospital for observation. 3 cars are damaged. 3 people are injured. And because you were the one who looked at your phone, you are 100% at fault. Now let's say you did what most new drivers do. You went online, you looked for the cheapest possible insurance, and you bought the state minimum requirement. Let's use a common minimum, like 25/50/25. You think, I'm covered. But what you're about to find out is that you're not covered. You're exposed. Let's break down that nightmare with these numbers. The first number, 25, stands for $25,000. That is the maximum your insurance will pay for any single person's medical bills. It's called bodily injury liability per person. The driver of that Lexus? The ambulance ride alone is a couple $1,000s. The ER visit with CT scans and MRIs to check for spinal damage can easily hit $15,000 or more. Add in follow-up appointments with specialists, physical therapy for months, and prescription medications. Their initial medical bills soar past $40,000. Your insurance policy writes a check for $25,000 and says, that's it, we're done. But the Lexus driver isn't done. They still have $15,000 in medical bills, and that's before we even talk about the fact they can't work as a freelance graphic designer because of the constant pain. That's another $10,000 in lost wages. And then their lawyer calls your insurance company. He talks about pain and suffering. And now they're suing you, personally, for the remaining $25,000, plus another $50,000 for their suffering. Where does that money come from? Comes from you, from your savings account, from your future paychecks. A court can issue a judgment against you, allowing them to garnish your wages for years, even decades. Every time you get a paycheck, a piece of it goes to pay for that 1 second you looked at your phone. And we've only dealt with one person. Now let's look at the second number, 50. That's $50,000. That's the bodily injury liability per accident. This is the absolute maximum your policy will pay for the medical bills of everyone you injured combined. We have the Lexus driver, whose bills are already way over the $25,000 per person limit. Then we have the person in the Honda with the broken wrist, the ER visit, the orthopedic surgeon, the cast, the follow-up care. That's another $10,000. The child in the minivan, thankfully, is okay, but the precautionary hospital visit and tests cost their parents $3,000. So the total medical bills are $40,000 for person 1, $10,000 for person 2, and $3,000 for person 3. That's $53,000. Your policy's total limit is $50,000. So even before any lawsuits for lost wages or pain and suffering, you're already in the red. Your insurance pays out its max, and you are personally on the hook for the rest. This is how young people end up declaring bankruptcy before they even finish college. Finally, we get to the third number. The last 25. That's $25,000 for property damage liability. This is the maximum your policy will pay for all the property you damaged. Repairing the rear bumper sensors and exhaust on that new Lexus? That's easily $18,000. The damage to the Honda Civic? Another $7,000. The dent in the minivan? $2,000. The total property damage is $27,000. Your policy covers $25,000. You get a bill in the mail for the remaining $2,000. And that was a good accident. What if you had hit a Tesla? Or a Porsche? A single fender bender with a high-end car can exceed a $100,000 property damage limit. Your $25,000 limit is a joke. It's a rounding error. So how do you fix this? How do you choose the right numbers? First, you need to completely erase the words state minimum from your vocabulary. The state minimum is not a recommendation. It is a legal trap designed to make you technically legal to drive, but financially destitute if you ever cause an accident. Think of it as financial minimum, not state minimum. The baseline you should be considering, the absolute starting point for any responsible driver, is 100/300/100. Let's run our nightmare scenario again with these numbers. $100,000 for a single person's injuries. $300,000 total for everyone's injuries in the accident. $100,000 for property damage. The Lexus driver's $40,000 in medical bills? Covered. The Honda driver's $10,000? Covered. The child's $3,000? Covered. The total of $53,000 is well under your $300,000 total limit. The $27,000 in property damage? Completely covered by your $100,000 limit. In this scenario, you don't get a single bill. You don't get threatening letters from lawyers. The insurance company handles it all. You fill out some paperwork, your rates might go up, but your life savings, your future, your financial freedom, it's all safe. Now, you're probably thinking, 100/300/100 sounds expensive. And here's the secret they don't want you to know. It's usually not. The price jump from a garbage 25/50/25 policy to a solid 100/300/100 policy can be as little as $15 or $20 a month. Maybe the price of a few cups of coffee. You are paying a few extra dollars a month to protect yourself from hundreds of thousands of dollars in debt. There is no better return on investment on the planet. So, is 100/300/100 the perfect number for everyone? It's a fantastic start. But the real answer depends on you. The rule is simple. You need enough liability insurance to cover your net worth. Your net worth is everything you own, your savings, your car, any investments, minus any debts you have. If you're a 17-year-old with a $2,000 car and $500 in the bank, 100/300/100 is probably great protection. But if you're 25, you have a good job, you've saved up $30,000 for a down payment on a house, and you have a 401k started, you're a bigger target. A lawyer suing you will see those assets. In that case, you should be looking at even higher limits like 250/500/100. This tells the world and their lawyers that you are well insured and not an easy target for a lawsuit. The more you have to lose, the more you have to protect. Liability insurance isn't about fixing cars. It's about protecting your entire life from that one single awful moment of bad luck or bad judgment. It's a shield for your future. We've just built the foundation. We've shielded your finances from the damage you could do to others. But this is only half the equation. In our nightmare scenario, 3 other cars were damaged and 3 other people were hurt. But what about you? What about your car, which is now crumpled and undrivable? What happens if you were the one with the broken wrist? Liability insurance pays for them, It does absolutely nothing for you. To protect yourself and your own property, you need two more critical pieces of coverage. And frankly, this is where insurance companies make a killing off of confused new drivers. Getting this part wrong can be just as devastating as choosing the wrong liability limits. And we're going to break down exactly what you need and what you don't in the next part. Alright, let's dive into the two coverages that protect the one thing you've probably worked hardest for: your actual car. We're talking about collision and comprehensive coverage. Think of these as the two essential shields for your vehicle. Liability, which we just covered, is a shield for your bank account against lawsuits from other people. These are for your ride. And let's be honest, for a new driver, your car is your freedom. It's your ticket to everything. So let's protect it the right way. First up is collision coverage. The name is pretty straightforward, but the implications are huge. Collision pays to repair or replace your car if it's damaged in, well, a collision with another object. That object is usually another car, but it also includes things like hitting a telephone pole, a guardrail, a fence, or even a particularly nasty pothole that sends you into a curb. It also covers damage from rolling your vehicle. Essentially, if you are driving your car and it makes impact with something that causes damage, collision coverage is your hero. Imagine this: you're a few months into driving, feeling pretty confident. You're pulling into a tight parking spot at the grocery store. You misjudge the distance to that concrete pillar, and crunch! That sickening sound of metal scraping against concrete. Your heart sinks. You get out and see a massive dent and a long, deep scratch down the passenger side door. A repair like that can easily cost $2,000, $3,000, maybe $4,000. Without collision coverage, that entire bill is on you. You either pay it out of pocket, or you drive around in a beat-up car, advertising your mistake to the world. With collision coverage, you pay your deductible, and the insurance company handles the rest. It's the "I made a mistake" insurance, and as a new driver, you have to be humble enough to admit that mistakes are not just possible, they're probable. Now let's talk about the other shield: comprehensive coverage. This one is a little less obvious by its name, but it's just as important. Comprehensive covers damage to your car from basically everything except a collision. Think of it as the acts of God and acts of jerks policy. This is the stuff that is completely out of your control. A hailstorm rolls through and your car looks like a golf ball. A deer decides to play chicken with you on a country road at night. A thief smashes your window and tries to steal your stereo. Your car gets stolen outright. A tree branch falls on it during a windstorm. Fire, floods, vandalism, riots. All of this chaos is covered by comprehensive. So, while collision is for when your car hits something, comprehensive is for when something hits your car. Without it, that stolen vehicle is just gone. And so is the money you paid for it. That cracked windshield from a rock on the freeway? That's on you. Comprehensive is the peace of mind that protects you from the sheer randomness of the universe. Now here's where it gets tricky, and where insurance companies love to confuse people. Both collision and comprehensive come with a critical component: the deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company pays a single penny. It's your share of the risk. Let's say you have a $500 deductible for your collision coverage. You get into that fender bender, and the total repair bill is $3,000. You pay the first $500 directly to the body shop. Your insurance company then pays the remaining $2,500. If the repair bill was only $400, well, since that's less than your $500 deductible, you're paying the entire thing yourself. Your insurance doesn't get involved. Deductibles typically range from $250 all the way up to $2,500. And here is the fundamental trade-off, the golden rule you need to understand. The higher your deductible, the lower your monthly premium will be. The lower your deductible, the higher your monthly premium will be. Insurance companies are betting on the fact that you won't get into an accident. If you're willing to take on more of the financial risk yourself by choosing a high deductible, say $1,000, they'll reward you with a cheaper monthly bill. If you want them to take on more of the risk by you only having to pay a small $250 deductible, they're going to charge you more every month for that privilege. So which one should you choose? This is not a trick question. The answer is brutally simple. And ignoring it is one of the single biggest financial mistakes a new driver can make. You should choose the highest deductible you can comfortably afford to pay, in cash at a moment's notice. Let me say that again. Your deductible should be no higher than the amount of money you have sitting in an emergency fund. If you choose a $1,000 deductible to save $40 a month on your premium, but you don't actually have $1,000 saved up, you have gained nothing. You've just signed up for a discount on a benefit you can't actually use. If you get into an accident, your car will sit at the body shop, collecting dust, while you desperately try to scrape together that $1,000. The tow yard fees will pile up. You might not be able to get to work. It can trigger a financial catastrophe. So be honest with yourself. If you only have $500 in savings, you should not have a deductible higher than $500. Period. Better to pay a little more each month than to face a financial crisis when you need your insurance the most. Now, this leads to an even bigger question. Do you even need collision and comprehensive coverage at all? This might sound like crazy talk after I just explained how important they are. But here's the thing. Unlike liability insurance, no state in the country legally requires you to have collision or comprehensive. They are optional. There is one major exception. If you have a loan on your car or you are leasing it, the bank or leasing company, the entity that technically owns the vehicle, will absolutely require you to have both. They're protecting their investment. But if you own your car outright, meaning you paid cash for it or have paid off the loan, the decision is entirely yours. So how do you decide? It all comes down to the value of your car. Insurance companies don't care what you paid for your car. They don't care about its sentimental value. They only care about one thing. Its actual cash value, or ACV. That's the replacement cost of the vehicle minus depreciation. In other words, what your car was worth the second before the accident. Let's say you're driving a 15-year-old Honda Civic that you bought for $3,000. It runs great, but its actual cash value is probably only around $2,500. Now let's say the combined cost to have collision and comprehensive coverage on that car is $100 a month. That's $1,200 a year. You're paying $1,200 a year to protect a car that's only worth $2,500. If you get into a major accident, the insurance company will just total the car and write you a check for its ACV, minus your deductible. So you get a check for $2,000, but you've been paying $1,200 a year for the privilege. Does that make sense? Not really. A good rule of thumb many financial experts use is the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, it might be time to consider dropping them. In our example, 10% of the car's value is $250. You're paying $1,200. It's way past the point of being a good deal. In this case, you'd be better off dropping those coverages, saving that $100 a month, and putting it into a dedicated car repair or replacement savings account. You become your own insurance company for your car's physical condition. So, to recap, if your car is new or has a loan, you need collision and comprehensive. No debate. Choose a deductible you can actually afford. If you own an older, lower-value car outright, do the math. Calculate its actual cash value using a site like Kelley Blue Book, get a quote for the annual cost of the coverages, and apply the 10% rule. Making this one smart decision could save you over $1,000 a year. Okay. We've covered protecting other people with liability. We've covered protecting your car with collision and comprehensive. But we've missed a huge piece of the puzzle. What about protecting you? What about your own medical bills if you get hurt in an accident? That's where the next layer of coverage comes in, and it's one of the most confusing, state-dependent, and critical parts of any policy. We're talking about medical payments and personal injury protection. And understanding the difference can be the key to protecting your health and your financial future after a crash. So let's dive right into one of the biggest points of confusion for new drivers: the battle between medical payments coverage, or MedPay, and personal injury protection, known as PIP. They sound similar, but in reality they are worlds apart. And which one you can get or are required to get depends entirely on the state you live in. This isn't a choice like picking a color for your car. This is dictated by law. To make this crystal clear, let's imagine two new drivers, both 18 years old, both with their first car and their first insurance policy. We'll call them Maya and Liam. Maya lives in Arizona, what's known as an at-fault state. Liam lives in Florida, a no-fault state. This distinction is everything. In an at-fault state like Maya's, if someone causes an accident, their insurance is responsible for paying for the damages and injuries they caused. It's a system based on blame. In a no-fault state like Liam's, the system is different. The law says that after an accident, you turn to your own insurance company first to cover your initial medical bills, regardless of who was at fault. The idea is to get people paid for their injuries faster and keep smaller lawsuits out of the clogged court systems. Now let's put Maya and Liam in the exact same scenario. On a rainy Tuesday afternoon, they both get into a fender bender. Someone runs a stop sign and T-bones them at a relatively low speed. The car is damaged, but more importantly, both Maya and Liam suffer the same injury: a broken wrist and some nasty whiplash. It's not life-threatening, but it's serious enough to require an ambulance, an emergency room visit, and follow-up care for the next few months. Let's follow Maya in Arizona first. The ambulance arrives. She goes to the ER. The bills start piling up immediately. The ambulance ride is $1,000. The ER visit with x-rays and setting her wrist is another $4,000. Now Maya was smart. When she bought her policy in her at-fault state, she added on $5,000 of optional medical payments coverage, or MedPay. Think of MedPay as a small dedicated fund specifically for initial medical expenses for you and your passengers, no matter who caused the accident. It's fast, it's easy, it pays out right away. Maya's $5,000 in MedPay immediately covers the ambulance and the ER bill. Fantastic. No out-of-pocket costs for her right now. It worked exactly as intended, but her journey is just beginning. Her wrist needs physical therapy. Her whiplash requires a chiropractor. These bills will easily exceed her $5,000 MedPay limit. So what happens now? Now she has to rely on her regular health insurance. Let's say her health insurance has a $2,000 deductible. She has to pay that out of her own pocket before her health insurance even starts to cover the rest. On top of that, she has co-pays for every single physical therapy session. And here's the other major problem for Maya. Because of her injuries, she can't work her part-time job as a barista for 6 weeks. That's over $1,000 in lost income. Does her MedPay cover that? No. Does her health insurance cover that? Absolutely not. Her only option is to file a claim against the at-fault driver's bodily injury liability insurance. She has to prove the other driver was at fault. She has to submit all her medical bills, document her lost wages, and essentially fight with another person's insurance company to get reimbursed for her deductible, her co-pays, and her lost income. This process can take months, sometimes even years. It's stressful, it's uncertain, and while it's happening, the bills are still due. Now let's rewind and check in on Liam in Florida, the no-fault state. Same accident, same injuries. The ambulance comes, he goes to the ER. But because he lives in a no-fault state, he was legally required to purchase personal injury protection, or PIP. Liam has a standard $10,000 PIP policy. Like MedPay, his PIP coverage is primary and pays out immediately, regardless of fault. So his ambulance and ER bills are covered right away, just like Maya's. But this is where their paths diverge dramatically. As Liam starts his physical therapy and follow-up appointments, his $10,000 in PIP coverage continues to pay the bills. But here is the game-changing difference. Remember how Maya couldn't work? Liam can't work his part-time job at the grocery store either. But PIP doesn't just cover medical bills. The P in PIP is for personal. It protects your personal financial well-being after a crash. PIP coverage in most states also covers a percentage of your lost wages. So while Liam is recovering, his own car insurance company is sending him a check to help replace the income he's losing. It might also cover things like hiring someone to help with essential services, like cleaning his house if his injuries prevent him from doing so. Liam isn't stressed about his health insurance deductible. He isn't worried about his lost paychecks. He isn't fighting with the other driver's insurance company. His own policy is taking care of him quickly and efficiently, up to his $10,000 limit. The system is designed to get him back on his feet without a protracted legal battle. If his injuries and expenses are catastrophic and exceed his PIP limit, he can then pursue a claim against the at-fault driver. But for most minor to moderate accidents, PIP handles everything. So let's break it down. MedPay is simple. It covers reasonable and necessary medical and funeral expenses for you and your passengers. It's optional in most states, and it's a fantastic idea to have it, even if you have great health insurance, because it can cover your deductibles and co-pays. But that's all it does. Medical payments. PIP is comprehensive. It covers medical expenses, but it also typically covers lost wages and other rehabilitation or essential service costs. It's mandatory in no-fault states. It provides a much broader safety net for your life, not just your body. So what does this mean for you, the new driver trying to build a policy? First, you need to know the law in your state. A quick search for, is your state a no-fault car insurance state? Will give you the answer. There are about a dozen no-fault states, so it's critical you know which camp you're in. If you live in a no-fault state like Florida, New York, or Michigan, you don't have a choice. You are required by law to carry PIP. Your only decision is how much coverage to get, and whether your state allows you to coordinate it with your health insurance. Our advice? Don't just get the state minimum. Think about your health insurance deductible. If your deductible is $3,000, a PIP policy of only $5,000 could get eaten up very quickly. Also, think about your job. If you were unable to work for a month, would you have enough savings to cover your bills? If not, a higher PIP limit is a wise investment in your financial stability. Now, if you live in an at-fault state like California, Texas, or Ohio, you'll have the option to add MedPay. And you absolutely should. For the vast majority of drivers, MedPay is incredibly cheap. We're often talking about just a few dollars a month. For that tiny cost, you're buying yourself peace of mind. You're buying a guarantee that if you're injured in an accident, you have a dedicated pool of money to cover your immediate ambulance bills, ER copays, and health insurance deductible without having to drain your savings account or wait to fight another insurance company. A $5,000 or $10,000 MedPay limit is a powerful tool that closes the dangerous gaps left by health insurance. So you've now figured out how to protect yourself medically and financially after a crash, whether it's through the comprehensive umbrella of PIP or the targeted assistance of MedPay. You've covered your own health, your own passengers, and even your own lost income. But every accident has two sides. You've prepared for what happens when you're the one on the stretcher. But what happens when you're the one who caused the crash? What happens when the person you hit starts talking about their medical bills, their six-figure surgery, their lost wages from a high-paying job, and their lawyer? That's when the two most important liability coverages on your entire policy come into play. And getting these numbers wrong will financially ruin you before you even get your life started. The first is called bodily injury liability. This is the big one. This is the coverage that pays for the medical bills, the pain and suffering, and the lost wages of the people you injure in an accident that's your fault. The second is property damage liability. This pays to repair or replace whatever you hit, whether it's their car, a fire hydrant, or the front of a Gucci store. Together, these two coverages are your shield against financial annihilation. Now, when you get a quote, you'll see these coverages listed as three numbers separated by slashes. Looks like code. You might see 25/50/25, or 100/300/100, or 250/500/100. This is the single most important set of numbers on your entire policy, and almost no one understands what they actually mean. Let's break the code right now. The first number is the maximum amount, in thousands of dollars, your insurance company will pay for a single person's injuries in an accident you cause. The second number is the maximum total amount they will pay for everyone's injuries combined in that same accident. And the third number is the maximum they will pay for all property damage you cause. So, let's say you have a 25/50/25 policy. That means your insurance will pay up to $25,000 for one person's injuries. A total of $50,000 for everyone's injuries if you hit a car with multiple people, and $25,000 to fix their car or any other property. Now let's go back to our accident. You ran the stop sign. You T-boned a brand new Audi Q7 driven by a successful surgeon. Let's call her Dr. Evans. The police report clearly says you are 100% at fault. Dr. Evans is rushed to the hospital with a broken leg and a severe concussion. Her car is completely totaled. Let's look at your 25/50/25 policy. This is the state minimum requirement in many states. You might think, I'm covered. I followed the law. But you didn't just follow the law. You walked right into a financial trap set for you. First, the property damage. That brand new Audi Q7? Its value is about $75,000. Your policy has a $30,000 limit for property damage. So your insurance company writes a check for $25,000 to Dr. Evans. That leaves a $50,000 difference. Who do you think pays that? You do. Dr. Evans' insurance company will pay to replace her car, and then their lawyers will come after you personally for the $50,000 you owe them. You're 19 years old and you're already 50 grand in the hole. But we're just getting started. Now for the bodily injury. Dr. Evans has a broken leg that requires surgery, with metal plates and screws. She spends a few nights in the hospital. She needs months of physical therapy. The initial hospital bill alone is $40,000. Your policy's limit for a single person's injury is $25,000. Your insurance company pays that $25,000. You are now personally on the hook for the remaining $15,000 in medical bills. So right now, with your legal state minimum insurance, you are $65,000 in debt. And the worst part hasn't even happened yet. Remember, Dr. Evans is a surgeon. Her job requires her to stand for hours, with intense focus and steady hands. With a broken leg and a concussion, she can't work for 3 months. Let's say she makes $300,000 a year. That's $25,000 a month. 3 months of lost wages is $75,000. That's a legitimate financial loss caused directly by your negligence. Guess who has to pay for that? You do. So let's tally it up. $50,000 for the car, $15,000 for the initial medical bills, $75,000 for lost wages. You are now $140,000 in debt. And we still haven't accounted for her ongoing physical therapy, or the biggest wild card of all, pain and suffering. This is a legal term for the non-financial impact of the accident, the trauma, the inability to live a normal life, the chronic pain. A jury could easily award her another $100,000 for that. Your state minimum 25/50/25 policy paid out a grand total of $50,000. $25,000 for her injuries, $25,000 for her car. You are now personally responsible for the remaining $240,000. $240,000. How do they get it from you? They sue you. They get a judgment against you in court. And with that judgment, they can garnish your wages for decades. That means every paycheck you ever earn for the rest of your life, they get a piece of it before you do. They can seize your assets. That car you just bought? It's gone. Any money in your savings account? Gone. Any future inheritance you might get? Gone. They will own your financial future before you've even had a chance to build it. This is not a scare tactic. This happens every single day in America. This is what financial ruin looks like. And it all started because you chose the cheapest, legal insurance policy. So what is the answer? You need to protect yourself. You need to buy liability limits that reflect the reality of the world we live in, not the bare minimum legal requirements set 40 years ago. Cars are expensive. Medical care is astronomical. At an absolute bare minimum, you should not even consider a policy with less than 100/300/100. Let's run the scenario again with those limits. $100,000 for one person's injuries, $300,000 total for all injuries, $100,000 for property damage. The $75,000 Audi? Your $100,000 property damage limit covers it completely. You owe nothing. The $40,000 in medical bills and $75,000 in lost wages? That's $115,000 total. Your $100,000 per person bodily injury limit covers most of it. You're left with $15,000 of liability instead of $240,000. It's still not perfect, but it's the difference between a manageable problem and a life-destroying catastrophe. Ideally, for the best protection, you should get $250/500/100. With those limits, Dr. Evans' car, her medical bills, her lost wages, and even a reasonable amount for pain and suffering would be completely covered by your insurance company. They would handle the lawyers. They would write the checks. You would fill out some paperwork and your life would go on. That is what insurance is for. It's a shield to protect your entire future. And here's the craziest part. The difference in price between a disastrous 25/50/25 policy and a protective 100/300/100 policy is often just a few dollars a month, maybe 20 or 30 bucks. It is the single best investment you will ever make. You are trading the price of a few cups of coffee for hundreds of thousands of dollars in protection. Do not be cheap on your liability limits. Ever. Max out what you can possibly afford. Now you might be thinking, okay, I'll get high limits to protect myself if I cause an accident. I'm covered. But in doing all this, we've overlooked one terrifying possibility. What if you're the victim? What if you're the one sitting at the green light, and some kid texting on his phone blows through the red and plows into you? What if he has no insurance at all, or even worse, he has that same garbage state minimum policy we just talked about? Who pays for your totaled car, your medical bills, and your lost wages then? The answer is going to shock you, and it involves a coverage that most people don't even know they have. The answer is you. You pay. You get the bill for the ambulance, the emergency room, the surgeries. You have to figure out how to replace your totaled car with no money from the person who caused it. And those lost wages from the weeks, maybe months you're unable to work? That's on you too. You could be financially ruined by someone else's mistake. all because they made the irresponsible choice to drive without proper insurance. It's a terrifying thought, and it happens every single day in this country. But there is a way to build a financial fortress around yourself. There is a specific type of coverage designed for this exact nightmare scenario. It's called uninsured and underinsured motorist coverage. And frankly, it might be the most important and most misunderstood part of your entire policy. This is the coverage that steps in and acts like the insurance the other driver should have had. It's your own insurance company coming to your rescue when a ghost driver, someone with no insurance, leaves you on the side of the road with a wrecked car and a mountain of bills. Let's start with the big one. Uninsured motorist coverage. The statistics on this are staggering. The Insurance Research Council estimates that about 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. Think about that for a second. The next time you're at a stoplight, count the first 8 cars around you. Statistically, one of them has no insurance at all. They are rolling the dice, and they are betting with your life and your financial future. If that person plows into you, their insurance is an apology if you're lucky. Your uninsured motorist coverage is what pays for your medical bills, your passengers' medical bills, your lost income, and even pain and suffering. It is your shield against the most irresponsible people on the road. Now you might be thinking, wait, what about my health insurance? Won't that cover my medical bills? Yes, it will, but with some major catches. Your health insurance has deductibles and copays you'll have to meet first. It has coverage limits. And most importantly, it does absolutely nothing to compensate you for the wages you lose while you're recovering and can't work. It doesn't help you with the long-term physical therapy or the chronic pain you might have to live with forever. Uninsured motorist bodily injury coverage is designed to fill all of those gaps. It's what makes you whole again, not just patching up the immediate physical damage. Then there's the other half of the equation, your car. If an uninsured driver totals your brand new ride, you need a way to replace it. This is where uninsured motorist property damage coverage comes in. It pays to repair or replace your car when the at-fault driver has no insurance to do so. Now, some of you might be saying, but I have collision coverage for that. And you're right, collision would also cover it. But here's the key difference. Making a claim under your uninsured motorist property damage coverage is often better. Why? Because the deductible is usually much lower than your collision deductible. And this is huge. It typically won't be counted as an at-fault accident, meaning it's far less likely to raise your rates at renewal time. You didn't do anything wrong, so why should your insurance record take a hit? So that handles the drivers with no insurance. But what about the problem we talked about earlier? The driver who has insurance, but it's that garbage state minimum policy that barely covers the cost of a new bumper, let alone a new car and a hospital stay. This is where the second, equally critical part of this protection comes into play. Underinsured motorist coverage. This is the real secret weapon. Let's go back to our scenario. You're in a serious accident. Your medical bills are $100,000 and your car is a total loss at $30,000. The guy who hit you was at fault and he has insurance. Hooray, right? Not so fast. He has the state minimum liability limit of $25,000 for bodily injury. His insurance company writes a check for $25,000, their maximum legal obligation, and washes their hands of the situation. You are now left with $75,000 in remaining medical bills, a $30,000 car loan you still have to pay off with no car, and no way to get to a job you can no longer perform because of your injuries. You can try to sue the driver personally for the rest, but let's be honest. Someone carrying the bare minimum insurance probably doesn't have hundreds of thousands of dollars in assets just sitting around for you to claim in a lawsuit. You can't get blood from a stone. This is the moment underinsured motorist coverage swoops in to save your financial life. It covers the gap between your actual costs and the other driver's pathetic coverage limit. So in this case, after the other driver's insurance pays their $25,000, your underinsured motorist coverage would kick in to cover the remaining $75,000 of your medical bills. It's your own policy protecting you from someone else's poor choices. It ensures that your recovery isn't limited by the size of the other guy's bank account. Think of it this way: when you select your liability limits, the amount your insurance will pay out if you cause an accident, you're basically choosing the level of protection you're going to provide to other people. When you choose your uninsured and underinsured motorist limits, you are choosing the level of protection you are giving to yourself and your family. You are essentially buying a policy for yourself that will step in and pretend to be the excellent high-limit policy that the irresponsible driver failed to buy. And here's the kicker. In many states, this incredible life-saving coverage is optional. Your insurance agent might not even bring it up unless you ask. They might just default you to the lowest possible option, or have you sign a waiver rejecting it altogether to give you the cheapest possible quote. They sell you on a low price, but what they're really selling you is a massive hidden risk. Because the few extra dollars a month this coverage costs are nothing, absolutely nothing, compared to the financial devastation of a single accident with the wrong person. It's the difference between a bump in the road and falling off a cliff. So, when you're getting quotes, you can't just look at the price. You have to look at what you're getting. You have to ask, does this quote include uninsured and underinsured motorist coverage? And how much? Because not having it or having it set too low is like walking a tightrope without a net. It's fine as long as you never slip, but the moment you do, the consequences are catastrophic. The decision to add this coverage is the decision to take control of your own financial safety, regardless of the millions of other drivers on the road. You can't control them. You can't force them to be responsible, but you can make sure that their irresponsibility doesn't become your personal bankruptcy. Now, the obvious question that follows is a crucial one. If this coverage is so important, how much of it do you actually need? Do you just match it to your liability limits? Do you need more? Do you need less? Getting this number wrong is just as dangerous as not having the coverage at all. If you set it too low, you're still exposed. If you set it too high, you might be overpaying. There is a sweet spot, a smart way to determine the exact right amount of coverage for your specific situation. And that is exactly what we are going to break down next. We're going to build your perfect policy line by line so you know you're bulletproof without wasting a single dollar. Alright, let's start with the absolute foundation of your policy. This is the part that isn't for you, it's for everyone else. This is liability coverage. It's the part of your insurance that is legally required in nearly every state. And it's the part that protects you from financial ruin if you cause an accident. Think of this as the core of your financial fortress. If this part is weak, the whole thing crumbles. Liability is broken down into two key parts: bodily injury liability and property damage liability. Bodily injury, or BI, pays for the medical bills, lost wages, and pain and suffering of other people you injure in an accident. Property damage, or PD, pays for the car you hit, or the mailbox you ran over, or the storefront you crashed into. Now, here's the single biggest, most dangerous trap that new drivers fall into. They look at their state's minimum liability requirements and think, great, that's all I need. I'll just get that and save money. This is, without a doubt, one of the most financially catastrophic mistakes you can make. Let me paint a picture for you. The state minimum for bodily injury liability in a state like California is $15,000 per person and $30,000 per accident. That means if you injure one person, your insurance will pay up to $15,000 for their medical bills. If you injure two or more people, the absolute maximum your policy will pay for all of them combined is $30,000. Does that sound like a lot of money? It's not. A single night in the hospital can cost more than $15,000. A minor surgery? Easily double that. What happens if you cause a multi-car pileup and you seriously injure 3 people, and their combined medical bills are $200,000? Your cheap state minimum policy pays out its $30,000 maximum, and then you are personally on the hook for the remaining $170,000. They will sue you, and they will win. And because you're young and don't have a lot of assets, they will garnish your future wages. For years, decades maybe. A significant chunk of every single paycheck you earn will go to paying off a judgment from a mistake you made when you were a teenager. That is not an exaggeration. It happens every single day. So, how much do you actually need? Forget the state minimums. They are a joke. They were set decades ago and have never kept up with the insane cost of modern healthcare and vehicles. You're going to see liability limits written as 3 numbers like 50/100/50. Let's decode that. The first number is the bodily injury limit per person in thousands, so $50,000. The second number is the bodily injury limit per accident, $100,000. The third number is the property damage limit per accident, $50,000. Here's a simple, powerful rule of thumb. Your liability coverage should be, at a minimum, enough to cover your net worth. What you own minus what you owe. But wait, you might be thinking, I'm a new driver, I'm 18, I have a negative net worth. I have a car loan and student loans. That's where you have to think differently. Your biggest asset right now isn't your car or the money in your bank account. It's your future earning potential. A lifetime of paychecks. That's what you're protecting. So let's build a better policy. Level 1, let's call this the good starting point. This is the absolute bare minimum I would ever recommend to anyone I care about. That's 50/100/50. This gives you $50,000 for one person's injuries, $100,000 total for everyone's injuries in the accident, and $50,000 for property damage. With the average new car costing over $45,000, that $50,000 in property damage gives you a fighting chance of actually covering the replacement cost of a single car you might total. It's a decent start. Level 2, the better option, and what I'd suggest for most new drivers who want real peace of mind. That's 100/300/100, $100,000 per person, $300,000 per accident, and $100,000 for property damage. This level of coverage protects you from the vast majority of common accidents. Hitting a newish SUV or a luxury car. That $100,000 in property damage has you covered. Causing an accident with multiple injuries? That $300,000 pool gives your insurance company the ammunition they need to settle the claims and keep you out of court. The cost increase to go from good to better is often surprisingly small, but the leap in protection is massive. Level 3, the best option. This is for when you start to build some assets, or if you just want to be virtually untouchable. This is $250/500/100, $250,000 per person, $500,000 per accident, and $100,000 for property damage. This level of coverage not only protects you from almost any conceivable car accident scenario, but it also often makes you eligible for something called an umbrella policy, which is a whole other level of financial armor we can talk about later down the line. So, to recap, forget state minimums. Start at 50/100/50, but seriously, get quotes for 100/300/100. It is the sweet spot for robust protection without breaking the bank. Okay, that's the coverage that protects you when you hurt someone else. What about when someone else hurts you? Especially someone who made the stupid decision to drive with no insurance at all? This is where uninsured and underinsured motorist coverage comes in. And it is absolutely non-negotiable. You must have this. Think about it. You're sitting at a red light, doing everything right, and someone plows into the back of you. They have no insurance. Zero. Your car is wrecked, you have a neck injury, you can't work for a month. Who pays for that? Who pays your medical bills? Who pays for your lost wages? Not the other driver, they have no money and no insurance. This is where your uninsured motorist, or UM coverage kicks in. It acts like the other driver's liability insurance, but it's on your policy. It pays for your medical bills, your lost income, your pain and suffering when you're hit by someone with no insurance. Underinsured motorist, or UIM, is similar. It kicks in when the person who hits you has insurance, but they bought one of those cheap state minimum policies we just talked about. Let's say your medical bills are $80,000, but they only have a $15,000 policy. Their insurance pays the $15,000, and then your UIM coverage can step in to cover the remaining $65,000. It is shocking how many people are driving on our roads illegally with no insurance. In some states, it's as high as 1 in 4 drivers. It is a massive game of Russian roulette, and you don't want to be the one who loses. The rule here is simple. Match your uninsured and underinsured motorist coverage to your bodily injury liability coverage. If you chose the better 100/300 liability limits, you should get 100/300 in UM/UIM coverage. You are protecting yourself and your family just as much as you're protecting strangers. Do not skimp on this. Next up is a smaller, but incredibly useful coverage, medical payments or MedPay. In some states, this is called personal injury protection or PIP, and it's a bit more comprehensive. Think of MedPay as your immediate, no questions asked health coverage for a car accident. It doesn't matter who was at fault. If you are injured in your car, or even as a pedestrian hit by a car, this coverage kicks in right away to pay for your ambulance ride, your emergency room visit, your health insurance deductible, your copays. It's usually sold in smaller amounts like $1,000, $5,000, or $10,000. While your health insurance will eventually cover your major medical bills, that can take time. MedPay is fast. It's designed to handle those immediate costs, so you're not paying out of pocket while you wait for the big insurance companies to figure out who is at fault. For a new driver, getting $5,000 in MedPay coverage is a fantastic, and usually very cheap, addition to your policy. It ensures that a trip to the ER after a fender bender doesn't also come with an immediate $3,000 bill you can't afford. So far, everything we've talked about has to do with injuries and damage to other people's property. We've built the fortress walls to protect your financial future from the outside world. But we haven't talked about the most important thing to you right now, your car. What happens when your car gets damaged? Whether it's your fault or not, That's where the two most famous and often most expensive types of coverage come into play: collision and comprehensive. And understanding how to set these up correctly is the key to managing the cost of your premium. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, or even a fire hydrant you didn't see. It covers you whether you're at fault or if it's a hit and run. Comprehensive, on the other hand, is for almost everything else. Think of it as the life happens coverage. It's for non-collision events that are mostly out of your control. We're talking theft, vandalism, fire, hitting a deer, a tree branch falling on your roof during a storm, hail damage, or flooding. Now, these two coverages are almost always sold together, and they are what people are talking about when they say they have full coverage. But here's the catch, and it's the single most important concept you need to grasp to control your insurance costs: the deductible. Both collision and comprehensive come with a deductible. This is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dime. Let's make this real. Imagine you're a new driver. Let's call you Alex. You just bought your first car, a nice used sedan. You get your insurance policy and you choose a $500 deductible for both collision and comprehensive. A few months later, you're pulling into a parking spot and you misjudge the distance, scraping the entire side of your car against a concrete pillar. It's an ugly deep gash. You take it to the body shop and they give you a quote for $3,000 to fix it. Because you have collision coverage with a $500 deductible, you pay the first $500. Then your insurance company steps in and pays the remaining $2,500. If you didn't have collision coverage, you would be paying that entire $3,000 yourself. Now let's rewind. What if Alex, trying to save money on the monthly premium, had chosen a $1,000 deductible instead? Well, in that same scenario, Alex would pay the first $1,000, and the insurance company would pay the remaining $2,000. Alex's monthly payment would have been lower leading up to the accident, but the out-of-pocket cost for the repair is now double. This is the fundamental trade-off. A higher deductible means a lower premium, because you're telling the insurance company, I'm willing to take on more of the financial risk myself in case of an accident. A lower deductible means a higher premium, because the insurance company is on the hook for more money, more quickly. So, the million-dollar question is, what deductible should you choose? There is no single right answer, but there is a right way to figure it out for you. It's called the sleep at night test. You need to look at your savings account right now and ask yourself, if I got into an accident tomorrow, what is the absolute maximum amount of money I could comfortably pay out of pocket without it causing a major financial crisis? Could you write a check for $500 without breaking a sweat? What about $1,000 or $2,000? That number, the one that doesn't make your stomach churn with anxiety, that's your starting point. For most new drivers, a $500 or $1,000 deductible is the sweet spot. A deductible lower than $500, like $250, often makes your premium so high that it's not worth the small benefit. A deductible higher than $1,000, like $2,000, can offer significant monthly savings, but you have to be brutally honest with yourself. Do you have $2,000 set aside in an emergency fund that you could use for a car repair tomorrow? If the answer is no, then that deductible is too high for you. You're essentially gambling that you won't get into an accident, and that's a risky bet for a new driver. The key is to balance the guaranteed monthly savings of a higher deductible against the potential and very painful out-of-pocket cost if something actually happens. Now let's talk about comprehensive. A week after Alex gets the car back from the body shop, a freak hailstorm rolls through town. The car is parked outside and it gets pummeled. The roof, the hood, the trunk, they all look like the surface of a golf ball. This has nothing to do with a collision. This is where comprehensive coverage saves the day. Alex takes the car in, the estimate is $4,000. If Alex has a $500 comprehensive deductible, Alex pays $500, and the insurance pays the other $3,500. If Alex didn't have comprehensive, that's a $4,000 bill. Hitting a deer on a country road? That's a comprehensive claim. Your car gets stolen from your apartment complex? Comprehensive. Someone keys your door in a parking lot? Comprehensive. It's the safety net for the unpredictable. But do you always need these coverages? Here's a pro tip that can save you a fortune. If you're driving an older car that isn't worth much, you might not need collision or comprehensive at all. You have to do some simple math. First, look up the actual cash value or ACV of your car. You can use a site like Kelley Blue Book to get a pretty good estimate. Let's say your 15-year-old car is only worth $2,000. Now, look at how much you're paying per year specifically for your collision and comprehensive coverage. You can find this on your policy declaration page. Let's say it costs you $800 a year for both. Here's the calculation. If you get into a major accident and total the car, the absolute most the insurance company will pay you is the car's value, $2,000, minus your deductible. So if you have a $500 deductible, you'd get $1,500. Is it worth paying $800 a year to protect a potential $1,500 payout? Maybe, but what if you do that for 2 years? You've paid $1,600 in premiums to protect a $1,500 asset. At that point, you're losing money. For many people with older, paid-off cars, it makes more financial sense to drop collision and comprehensive, take the massive savings on their premium, and put that money into a dedicated car repair or replacement savings account. You are essentially self-insuring. However, there is one giant exception to this, and for most new drivers, it's a non-negotiable. If you have a loan on your car or if you are leasing it, the bank or leasing company, the lien holder, owns the car. You're just making payments on it, and they will almost certainly require you to carry both collision and comprehensive coverage with a maximum deductible, usually no more than $1,000. Why? Because they need to protect their investment. If you total the car and don't have the coverage to fix or replace it, they're the ones who lose their money. So if you're financing your first car, plan on having full coverage. It's not a choice, it's a condition of your loan. So you figured out your liability limits, you understand your medical payments, you've wrapped your head around uninsured motorist coverage, and now you know exactly how to choose the right collision and comprehensive deductibles for your situation. You have built the perfect policy structure. You are now more knowledgeable than 95% of drivers on the road. But building the policy is only half the battle. Now comes the fun part. Finding all the hidden discounts and secret tricks to make that policy as cheap as humanly possible, without sacrificing the protection you just so carefully constructed. And that involves knowing exactly what to ask for and where to look for it. Let's break this down into a strategic game. Think of it like a video game where you've built your character. That's your policy. And now you're entering the final level to equip it with the best gear for the lowest cost. The insurance companies have a list of discounts, but they're not always going to just hand them over. You have to know the cheat codes. First up are the discounts tied directly to you, the driver. The most famous one is the Good Student Discount. And this is a big one. Insurers see a student with a B average or higher as more responsible, less likely to take risks, and therefore a better bet. We're not talking a few bucks here. This can be a 5 to 25% discount. That's massive. But here's the trick. Don't just assume they'll apply it. You need to be proactive. When you get a quote, you say the magic words. I'd like to apply the Good Student Discount. They'll ask for proof. A recent report card, a transcript, so have it ready. And this isn't just for high schoolers. If you're in college, even grad school, and under 25, you likely qualify. That's a discount you can keep for years. Right alongside that is the Defensive Driving Course Discount. This is one of the best investments a new driver can make. You pay a small fee, maybe $50, for an approved online or in-person course. You spend a few hours learning to anticipate hazards and react safely. When you're done, you get a certificate. You send that certificate to your insurance company, and boom, they'll often knock another 5 to 10% off your premium for up to 3 years. You do the math. A $50 course could save you hundreds of dollars over that time. It pays for itself many times over. You are literally turning a weekend afternoon into a recurring discount. Next, let's talk about the discounts tied to your vehicle. The car itself is a treasure trove of potential savings. Insurance companies love safety. The safer your car is, the less likely they'll have to pay out a big claim. So they reward you for it. Does your car have anti-lock brakes? That's a discount. Airbags? That's a discount. Daytime running lights? Discount. An anti-theft system, whether it's a factory-installed alarm or a tracking device like LoJack, that's a huge discount. When you're getting a quote, they'll ask for your car's vehicle identification number, or VIN. This tells them a lot of the standard features. But sometimes things get missed. It never hurts to verbally confirm. My policy includes discounts for anti-lock brakes, airbags, and the factory anti-theft system, correct? Make them check the boxes. Now for the most controversial, but potentially most powerful discount of all, telematics. This is also known as usage-based insurance. This is where the insurance company gives you a small device to plug into your car, or has you use an app on your phone. This little spy tracks your driving habits. It tracks how fast you accelerate, how hard you brake, what time of day you drive, and how many miles you cover. It's the ultimate show don't tell approach to insurance. You're telling them, don't judge me based on my age. Judge me based on how I actually drive. If you are a genuinely safe driver, you don't speed, you don't slam on the brakes, you're not driving at 2 in the morning every weekend. This can be a game changer. The discounts can be up to 30 or even 40%. However, this is a double-edged sword. If you have a lead foot, or a job that requires late-night driving, this program can actually work against you and potentially raise your rates. So be honest with yourself. If you're a cautious driver, ask about their telematics program, like Progressive Snapshot or State Farm's Drive Safe and Save. If you know you're a bit more spirited, it's probably best to skip this one. Okay, let's move on to the lifestyle discounts. This is where you get rewarded for how you've structured your life. The biggest one is bundling. This is the one you see in every commercial. Bundle your auto and renter's insurance. Bundle your auto and home insurance. And yes, it usually saves you money. But here is the secret trick the commercials don't tell you. Not always. Sometimes an insurer is great at auto insurance but terrible at renter's insurance. They might give you a 10% bundling discount, but their renter's policy is so overpriced that you'd actually save money by keeping them separate with 2 different companies. So always get 3 quotes. One for just auto, one for just renters, and one for the bundle. Compare the total cost. Let the math decide, not the marketing. Next up is a hugely overlooked category: affinity discounts. This is a fancy term for getting a discount because you belong to a certain group. Are you a college graduate? Check if your alumni association has a partnership with an insurance company. Are you a member of a specific credit union, a professional organization, a fraternity or sorority, or even a wholesale club like Costco? Many of these groups have negotiated special rates for their members. Are you active duty military or a veteran? Companies like USAA and Geico offer significant military discounts as a thank you for your service. You have to ask. These are almost never applied automatically. You have to say, do you offer any discounts for alumni of your university? Or do you have a discount for members of your organization? You'd be shocked at what's out there. Finally, there's the low mileage discount. If you're a student living on campus and your car barely moves, or if you work from home, you are a much lower risk. Why should you pay the same as someone with a 50-mile daily commute? Tell the insurance agent what your estimated annual mileage is. If it's under a certain threshold, typically around 7,500 miles a year, you can unlock another significant discount. So now you're armed. You've built your perfect policy. You have a checklist of every possible discount you qualify for. You've gotten quotes from at least 3 to 5 different companies. This is the final showdown. You take the best quote you received, let's say it's from Geico, and you call the runner-up, let's say it's Progressive. You don't have to be aggressive, you just have to be honest. You say, "Hi, I'm a new driver looking to finalize my policy. I really liked what Progressive had to offer, but I have a competing quote from Geico for the exact same coverage that's $20 cheaper per month. Is there anything you can do to match or beat that price?" This is the moment of truth. Sometimes they'll say no, but often the agent will say, "Let me see what I can do." They might go back, rerun the numbers, and find one more little discount they forgot to apply. You can save hundreds of dollars with that one simple, polite phone call. And this brings us to the single biggest piece of advice in this entire series. The number one mistake that costs drivers thousands of dollars over their lifetime is this: setting it and forgetting it. You do all this work, you find a great deal, and you think you're done. You are not. That great rate you got is an introductory rate. It's designed to get you in the door. But over time, rates creep up. They call it price optimization, which is a corporate phrase for charging loyal customers more because they know they're unlikely to leave. Your loyalty is often punished, not rewarded. So here is your final mission, the one habit that will keep your insurance affordable for the rest of your life. Every 6 months, or at the very least once a year when your policy is up for renewal, you must reshop your insurance. Set a reminder in your phone. It doesn't have to be as intense as this first time, but take 30 minutes and get a couple of new quotes to make sure your current company is still giving you a fair price. It's the only way to keep them honest and ensure you're never overpaying. And that's it. We've gone on a journey. From the paralyzing fear of that first premium quote to understanding what liability and collision actually mean. We've learned how to build a policy that protects your future, not just your car. And we've uncovered the strategies to make that protection affordable. You are no longer just a new driver. You are an informed consumer. You have the knowledge and the power to walk into this transaction with confidence, to ask the right questions, and to get the value you deserve. This isn't just about car insurance anymore. It's about taking control, making smart financial decisions, and starting your driving life on the right foot. Now go get the policy you've earned.